Hi, everybody, and thank you for coming today. I'm Lynette Zhang, Chief Market Analyst here at ITM Trading since 2002. Since 1964, I've been a collector and a banker and a stockbroker. So it should be pretty easy to see that I have been groomed for this moment in time. And I am on a mission. My mission is to convert financial noise into understandable and believable language for everyone. A little disclaimer before we begin. ITM Trading recommends that 5 to 20% of your overall investment portfolio be placed in precious metals. However, the decision as to how much to allocate is strictly up to you and/or your financial advisor. You should be aware that my opinions may or may not reflect the opinions of ITM Trading. So grab a pad and pen, jot down any things that come up for you, type any questions, and I'll answer everything at the end of this short presentation. So today we're going to begin with welcoming you to a peek beneath the skin of the market, which is all about enabling educated choices. Today's topic is on the central banker's big experiments. Now, what I really want you to know in this is that the great Keynesian experiment that began in 1913 is coming to an end. And frankly, no one knows the exact moment that the market break will become obvious to you. Just like no one knew even 1 second before that the system, the financial system that we grew up with, died in October of 2008. What I'm going to show you today is why I believe that we are very, very, very close to that very visible break, and that the central banks are out of ammunitions to keep anything hidden. So we're going to look at some of the insane things because the only tools left are in their imaginations. And let me tell you, these are some pretty interesting imaginations. But the tools that they're already implementing are negative rates, which actually charge lenders and pay borrowers. Quantitative easing expanded debt levels for governments and corporations to historic heights. Never before has this been done. And easy money policies mean that almost anyone can borrow from the central bank using almost any collateral. But the bottom line is that these extreme policies indicate the end of a trend cycle. And in this particular case, the end of that Keynesian experiment. Fiat money systems, and I just want you to think about this, but a fiat money system is based upon compounding inflation. Well, when you have that, at some point, there's no value left in the currency. And that's where we are today. And that's also why central bankers are forced into experiments to try and keep this going. But before we begin, I want to take a very quick long-term view so we can put this whole thing into perspective. And you'll see why I'm saying that the central bankers are out of tools. Now, a couple of things that I'd like to point out here. Number one, in the past, when we've had bouts of hyperinflation, and typically governments go off the gold standard of fund war, and the currencies hyperinflate, and then they go back. But typically, central bank charters, or the life cycle of a central bank, was 15 to 20 years. That's it. And wars were a lot shorter back then, between 4 and 8 years. So there was an opportunity between those times to recoup economically via the gold standard. However, today we have perpetual central bank charters. I mean, the original one in 1913, the charter was a 20-year charter. So 1933, the Federal Reserve would have had to have been reinstated. But you can see 103 years later, they're still here. That's a perpetual charter. And even though the wars have heated up, or the the time between wars grew shorter and shorter. Since 1987, we've been in a perpetual state of war. It is not a coincidence that the state of perpetual central banking coincides with perpetual wars. So now I want to show you this graph, which compares debt creation, money creation, and inflation. And you can see what it looked like when we were on the gold standard, and this is when the experiment began. But up until this moment, 1971, either individuals and governments or just governments could convert government money, US dollars, into US gold. After 1971, no governments could convert fiat money into good money. And we see the results of this because this is since the central banks have had absolute control over the inflation. But the great experiment that started over here was this was the first time where they actually tried to control the speed of the inflation. Previously, during those wars, everything was too short. The charter was too short, the wars were too short, so the inflation happened rapidly, hyperinflation, and then collapse. This experiment was about having it, the target is 2%, so that you don't really notice, and the end result is there's only 4 cents left out of the original dollar. So the great Keynesian experiment was the ability to control the speed of the inflation. And since it's gone exponential and it's moving more and more rapidly, do you really think that this can go on forever? I mean, really? Think about these things logically. You don't need to understand the specifics. You just need to think about them logically and put it into perspective for you. Because the derivative bets against the subprime mortgages is really what killed the system back in 2008. They even admitted it then. Wall Street reshaped our financial markets. There's, and what can be done? Because central bankers acted very rapidly and aggressively with every single bit of firepower that they had. They dropped interest rates to zero. They put trillions and trillions of newly created taxpayer debts into the banks to try and stop the bleeding, but it didn't even slow it down. So what do? Well, they start to get very creative and they experiment and they hope to create enough inflation to offset the crushing debt levels that is deflating the global economy. So what I want to do now is review just a few of those big, insane experiments. You can see this for yourself. And I'm going to start with negative interest rates because that goes completely against economic law. Never before have interest rates been at zero, but it was inevitable because since 2008 and up until this chart goes to March of 2016, central banks have cut interest rates 650 times. That averages an interest rate cut every 3 days for the last 8 years. I mean, come on, I want you to think about this. This is craziness. In addition, some that are in that category, 40% of the European government bonds are at negative yield. And in just 4 short months, when Japan announced negative rates, 70% of their bonds are in negative yields. That doesn't make any sense. Plus, you're agreeing to those negative yields for up to 30 years. I hope that you can see the insanity in what I'm trying to tell you here, because negative rates are crazy. I mean, think about it for yourself. You've gone out, you've earned all of this money. It took a whole lot to accumulate it in after-tax dollars, but hey, I know you can't pay me back. Let me loan it to you and I'll pay you to borrow it from me. I mean, most likely if you're going to do that, you're going to do that with your children. Would you do it with anybody else? Does it make any sense? Can you see that central bankers no longer have a credible interest rate policy? It's gone. 90% of the world is anchored at 0% interest rates or less. And since all of these negative rates really benefit the debtors, is it any wonder that debt levels are at the highest level ever? But the reality is, it's insane to think that you can solve a too much debt problem, a debt bubble that burst, with even more debt. They've almost doubled the level of debt since this crisis began in 2008. Okay? It doesn't make any sense. So put it down at your level. Okay, you can't pay the debt that you already have, so you go out and you take out twice as much debt. Does it relieve you? For a moment, because you can use that new money to pay that old debt. But at some point, that bill comes due. This IMF report that they put out, we're going to talk a little bit more about this in a minute, is basically telling you that that debt is due now. So what did governments and private corporations do with all that new money? Well, stock buybacks and a few other choice things, but they certainly did not lend it out into the economy or, frankly, to each other. Now, this is a pyramid from the report that the IMF, out of that headline report. And you'll notice that where they put the base of it was in systemic market liquidity. Now, liquidity, in every market you have to have a buyer and you have to have a seller, and then they work together. But all of that QE money that went into the banks and the different governments, what did they do? They pulled liquidity out of the market. For example, the Bank of Japan now is a top 10 shareholder in about 90% of the Nikkei index. Those stocks, can they sell them back into the market? No. And with that level of balance sheet in this next crisis, can they buy even more stocks? Well, that's what they just did for Brexit. But I'm thinking that we're going to get to a point where that is overwhelmed, where the selling is overwhelmed. And at that point, all of that wealth is locked in wherever it remains. This is that global liquidity chart, just to give you an indication, from the Bank of International Settlements. You can see the liquidity indicated here. And notice that it's pretty much on the top above the line. But look at what's happened since the crisis. There is no liquidity. There are no buyers in these stock and bond markets. It is governments and it is central banks. And they will do it as long as it benefits them. But when it no longer benefits them, it's over. They are no longer going to be buying and providing that little bit of minimal liquidity that's in there that you saw on there. So what they've really done over the last 8 years is they have used this to cover up the shift, the transfer of risk from the private sector that created this mess, the banks and the other corporations, to the public sector, the taxpayers that pay for this mess. Now, to me, that's pretty insane. You might disagree with that, but you and I will be on the hook for this next crisis too. That's the final wealth transfer. Now, we also hear so much about how central banks and they want to stimulate the economies and stimulate the economies. Okay, well, that makes sense in this environment. They're trying to generate inflation. But here's my question. With all of that talk about stimulation, why would one of the very first new creative tools that you come up with be to pay banks to hold reserves. In other words, pay them not to lend. This is from a recent New York Fed report, and they looked at kind of a before and an after. Just so you can see the scale according to them, watch this. Okay, this is the bank lending, and you can see how much that's grown, and these are the reserves, and you can see how much that's grown. Of course, in addition to the banks, oh, that's right, I'm sorry. So they started out by paying them 1/4 basis point back in 2008, and in December 2016, they doubled it. So the interesting thing for me, and I have all the documentation on any of this that you want to see, I'm happy to send you the links, but according to the Federal Reserve, banks pay 0. So all of this talk of raising interest rates is actually increasing the interest rates that they pay to the bank to hold reserves. There's something a little squirrely with that picture, but let me give you a different view of it. Because these are the excess reserves of the banks, and it goes back to the very beginning of this graph, of this, since they started tracking it rather, and take a look at it. Flat line, flat line, flat line, flat line, and here's the crisis. Okay? All of this excess money that they borrow, taxpayer money, that they borrow at 0, they're getting paid 0.5% to hold it. Are you getting 0.5% on your checking account or your savings account at the bank? I don't think so. But that's not the worst of it either, because all of the easy money policies means that almost anybody can go to the central bank and borrow with almost any collateral. This is from a Bank of International Settlements report on the collateral tools. All of these red circles that you see here represent brand new tools. And this is a recent report, but it only goes through 2012. They've created even more tools since then. And I hope it's pretty easy to see that all of the new tools, which by the way also have a bunch of sub-layers, dwarf the amount of traditional tools left in their arsenal. Now, we do know how easy money policies in 2002 created the real estate bubble and the derivatives associated with it, and we know how that worked. Not real well. So might it kind of be a little bit crazy to trust those proven to be untrustworthy? I mean, how much admitted manipulation do the banks have to do? How many fines do they have to pay before you realize that you probably shouldn't just trust them? But there are a lot of other experiments that are carried out by the global central bankers, and it's all in a quest to regain control over inflation. So with all of these things that they have been doing, one of the questions has to be, are they working? Are these experiments working? I don't know. Let's take a look. Well, I actually do know, and I'm going to show you. This is out of a Federal Reserve graph, and it shows you that the amount of economic activity, the stimulation, is worse today than by a wide margin than it was during the Depression in '33. So, does this look stimulated to you? Therefore, do you think it worked? That would be a no. Definitely didn't work. This is during the Depression. This goes to 1913, or 2013. So since they know that it doesn't work, what in the world do you think some of those new tools might be? Well, obviously, one of the things that they've been talking about quite a bit is going to a cashless economy. If they take away cash, then there are no restrictions on how low they can push those interest rates. Another way to say that that's really more accurate, if they get rid of cash, then there are no restrictions on how much they can actually charge you to loan them money. So you open your bank statement, you got $1,000, the next day you got 900, the next day you got 400. What are you likely to do? You're likely to spend it in anything that you think might preserve your principal. But if that's not enough, another thing that's being discussed pretty much daily, I'm hearing somebody, a central banker or what have you, talk about this daily, is helicopter money. In helicopter money, they actually bypass the banks, because obviously the banks are holding them. Of course, they're being paid to hold the reserves. But they bypass the banks and they give the money directly to those that are most likely to spend it. Now, that might sound like a pretty good deal, that magically you open up your mail one day and there's a $100,000 check. And yes, you might certainly redo your house or go buy something or start a business. You might do something with that money. You are clearly more likely to do that than the banks. But that definitely would also send us into hyperinflation. So, the question becomes, since they're trying to get control of inflation, and you know what your cost of living has done since 2008, just think about that for a minute. Do you really think that they're going to be able to control this inflation genie once it gets out of the bottle? Because I really don't. And these policies cannot go on forever. They cannot. Nothing goes on forever when it's straight up. Nothing goes straight up. Nothing goes straight down. You got to have some bouncing along the way. And all of these graphs that I've shown you as far as inflation and goes, they're all exponential. They're just going like this. It can't happen forever. And let me show you why I say that and why I think we are very, very close to a break in this. Number one, the income that the world generates, so the world GDP, is on a decline. And every time the IMF, the World Bank, the Bank for International Settlements comes out on the economic outlook, what do? They lower the outlook. Well, this is the money that's supposed to pay all of that debt. So this is a problem. If you are over your head in debt and your income declines, you don't think you're going to have more problems paying that debt? But in the meantime, this is the world stock market. Now, you can see that it's up, but that's because that's what you and I look at. I do look at it. I don't believe it because I know the truth. But if you open up your 401k statement and it doesn't look horrible, then you go, oh, everything must be okay. So it becomes imperative for central banks and governments to support the stock market. And frankly, they can do it until they can't. And I don't think we're very far from that, because look at this. I mean, the debt levels are exploding, as we've seen over and over again, and interest rates, as we've also seen over and over again, are at 0 or less. Now, let's put this into perspective. If you are over your head in debt and you're taking on more and more and more debt, and you decide you want to buy something, you think you're going to get the best interest rate? Of course you won't get the best interest rate. All of these markets are managed, and they can do it as long as the public has confidence in the system. But that's another problem, because confidence has been eroding since 2008, but it's becoming a whole lot more visible. I mean, that's what the Brexit vote was about. It was a vote of no confidence in the government. But that's not the only place that that's happening. It's happening all around the world. And in this country, that's why we have the candidates that we have. Because people feel like they're not heard. They don't trust the government. And you can see that this is at the lowest levels ever. This is an accident waiting to happen. Because in addition, you have a polarized economy, where the haves have a lot more and the have-nots have a lot less. And these are the kind of things that undermine the confidence in the entire system. In this case, it looks like the confidence in the politicians is going first. But all you need is a good scare that they can't cover up, and this will erode very rapidly. And unless something more important comes up, the webinar next month is going to be on this confidence piece because it's critical. That's the only thing holding this system together. But the other part that I want you to understand is that this is from the Wall Street Journal. Can you get more Main Street than the Wall Street Journal? And every day they're talking about how the markets are crazy. The markets are insane. A world turned upside down. So if that's where you're holding your fiat money wealth, it frankly is at high risk. So what do you do about it? Well, you get to safety, and that's gold. So how does gold perform during deflation, which is where we are right now, during hyperinflation, which lies in our future, or even in the normal markets leading up to where we are? Let's take a look. This is gold's performance during deflation. So it positions you for opportunities. This, and if you've watched the webinars, you've seen lots and lots of these charts. This is what it looks like when we go into hyperinflation. And that enables you to take advantage of those opportunities. So that's how it performs in deflation. That's how it performs in inflation. Now, how's it performing right now? An interesting thing to note, and I really want you to think about this. In today's environment, and this is just growing and growing, gold pays no yield. And yet, it gives you a higher yield than any of those bonds in the negative universe. That is growing quite rapidly. Think about that, because that's pretty significant. So, frankly, even Wall Street's spot gold has outperformed currencies, stocks, and bonds during this trend. This goes back to 99. Now you say, but that goes back to 99. How about shorter term? Well, okay, this is that same chart, and it just goes back to January. So it should be pretty clear from both of these relative performance charts and from everything else I hope that I've shown you that gold is a safe haven to hold your purchasing power and position you not just to survive what we're going through, but dare I say it, to actually thrive through it and grow that dynastic wealth. And this is why I always tell you that gold money should be the foundation of every portfolio, just like it is for that dynastic wealth, that wealth that's lasted in families over 300 years. This is the foundation of that wealth because it prevents inflation and it runs no counterparty risk. It's used throughout the global economy. So there is always a market for gold. You hold it, so you control it. You own it outright. It is frankly the ultimate hedge. And right now, as we know, it is severely undervalued to its fundamental value. So it's on sale. Thank you very much, central bankers. That's one thing I can certainly thank you for. It should be, and it is indeed, the single most conservative, in my opinion, the single most conservative part of any portfolio because it ensures your purchasing power value. That's what we all work for. And here at ITM Trading, we have a strategy, and it's based upon those repeatable patterns and valuations. Because even though I can't guarantee the future, if something's happened 100% of the time and we're in the same circumstance, my bet is the most likely outcome is it's going to happen again. So, I hope that you had a chance to really see, and if you just think about all of this logically, that great Keynesian experiment that started in 1913 is near its end. I mean, it is. We're in the deflationary part that happens just prior to the hyperinflation. I believe so strongly that you'd better be positioned to weather this financial storm, because we're not going to get, or in my opinion, it is not likely, that we are going to get another opportunity like we have between 2008 and now. So please don't squander it. It's food, water, energy, security, barterability, and wealth preservation. Gold and silver do those last two pieces. But you can see they're out of tools, and they're grasping at straws. Anything, save me, Mr. Bill, save me. Anything that they can come up with. But even these experiments, they're not working the way they anticipated them to work. It's not working. I don't know what else to say. I'll show you lots more stuff, because you know I will every month. I'll show you more stuff. But the bottom line is that these extreme measures show you that we are at the end. And now I'll open the floor to questions. Okay. Let's see. Oh, nice to see you too, Larry. Thanks. And Ben asks, could you please go into more detail on how gold goes up when markets deflate? Well, you know, that's an interesting question, and even the way that you put it, how gold goes up. Well, gold goes up in terms of fiat. So let me move this over here. Give me 2 seconds, and let's go back to that relative performance chart. Let's see, which is right here. Okay. Now, some of you that have been coming to this series for a while very well might recall that it was August of 2015 when the Chinese market started to implode, that we entered the deflationary part of this trend. And you can frankly see how gold has performed in terms of dollars and relative to the other fiat money products. Because what's the response? There's only one way to fight deflation, and that is with inflation. And since gold holds your purchasing power, really doesn't change. I mean, you could have bought a men's suit of armor 6,000 years ago for an ounce of gold. At the turn of the century, you could have bought a wonderful men's suit for an ounce of gold. And today, at $13.60 or wherever it happens to be at the moment, you could still buy a wonderful men's suit. So it's not really gold that changes. It's the number of dollars or fiat money that it takes to buy it. So when we're in that deflationary mode, what are governments and central bankers doing? They're creating as much new money as they possibly can. So then the dollar loses value, that goes down, and gold in terms of dollars go up. When they've lost their choice and they go into what they're calling, you'll hear this word, reset, that's when they revalue the dollars, or they revalue gold, I should say, in terms of dollars. Gold goes to its fundamental value, which is over $8,500 at the moment, regardless of what Wall Street wants you to believe. Okay, but that's in terms of dollars. When we're in the reset, if it went to $87 trillion, like it did in Germany during their hyperinflation, you could not convert that $87 trillion into a loaf of bread. You could convert 20, on average, this is the global average, 25 ounces of gold into an entire city block, buildings and all. That is the global average of what happens during hyperinflation, during the reset. So I hope that answered your question. And let's see. Oh, you're welcome, Henry. I am so happy to be of service, which of course you know. We've been together for a while. And Taylor asks, I know that the markets are rigged and that the analysts on mainstream media work with the powers that be. Why do I hesitate to move forward when I know it's the right thing to do? Oh, well, I'm not really a psychiatrist. However, this is called perception management. And we've been born into the lie, and we've been taught the lie as the truth. And we've been taught that, first of all, we've been taught that you can trust intangible instruments, the fiat money instruments, so stocks or bonds or things that you can't hold on to and you really can't take full ownership of. So, you know, this is your paradigm. This is your belief that this is the right thing to do. And that's really what holds you back, because on the one hand, you know logically that this doesn't make sense, but this is a different step. And they've told us forever, particularly since 1933. And again, the campaign started in earnest after 1971, that gold has it's worthless. It's just an old rock. In fact, how many times have I heard people say, well, you can't eat gold? Well, that's true. But gold is used throughout the economy, so there is always a buyer. So you can always actually convert gold into any good or service. You can't eat dollars, and you can't take your statement for your 401k statement to the grocery store and buy food. And dollars and those things are only used in one place, so they have no intrinsic value. But the reason why you hesitate is your paradigm. And, you know, sometimes what you have to do, especially when you think about these things logically and you go, this doesn't make any sense at all. You know, sometimes what you have to do is take a deep breath and move forward in a positive way that supports your goals and what you're trying to accomplish. That's the other piece of this. So many times people will say, well, this is what I want. Okay. I'm talking about being specifically, well, I want, you know, silver. Okay, well, I think that's a good idea that you want silver, but what is it that you want to accomplish? And then they might say, well, I want this or that or the other thing. What you always want to do is you want to establish your goals first. And then you make sure that whatever it is that you're doing supports those goals. Just don't take anybody's word for it blindly. Prove it to me. Prove it to me. If everybody asked their stockbroker, their banker, their insurance agent, whoever they're going to prove to you why they should do what they are recommending you do, there would be a lot less business going on. But your goals would be more supported. So I think that's an important one. Okay, if there is a stock market correction or crash, what tools will the bankers instate at this point? You know, they've been getting ready for a long time. The cashless piece can be in place within weeks during the next crisis. That's what they told us in that report. There's a whole webinar on it. So my bet is that they're going to take us cashless first, and they're going to force us to go out and spend whatever fiat money we have on sodas, on, you know, whatever garbage, whatever we can do it with. But my guess is probably cashless first, though they're also talking about the helicopter money. So who knows? Maybe you'll get a check for $150,000 in your mailbox during the next crisis. It's possible, because actually that was the amount, if I remember correctly, that was the amount that every taxpayer would have gotten instead of what they gave to the banks, which, as you saw, have remained in the reserves. When they recapitalize the system against gold, could they confiscate gold from citizens? Well, honestly, governments can do anything they want. So can they do it? Absolutely, they can do it. And personally, I've done a study on all the laws on the books pertaining to gold. It's in the IRS documents, a clear delineation between monetary gold and collectible gold. You know, a good place to start to see where that might happen is, what does the IRS say you can hold in your IRA? Because they say you can only hold monetary gold in your IRA. So my personal preference, and everybody has to do what they're comfortable with, and this has certainly not always been true in this trend cycle, but personally, I don't own any bullion because I don't personally see any way around an overt confiscation. And remember, the goal is not for you to hold your wealth. The goal is wealth transfer. They want to inflate your wealth away. So, you know, and I'm not talking distant history where they've confiscated right now, Venezuela. You know, I mean, there are a lot of places that are in hyperinflation mode right now, and the citizens lost the monetary gold before that kicked into gear. So with gold so spot market, and actually what you can buy, physical gold, so severely undervalued, and there's just a teeny premium in there, you can consider that your wealth insurance. And if they don't confiscate, no problem. And if they do confiscate, now you have the only kind of gold that can be used through the normal marketplace. What's the premium and the value on that one? Oh, let's see. Oh, I guess that's it. Does anybody have any other questions? Oops. Okay. Has there been a difference in performance between bullion and the collectible gold? Well, at different times, certain things lead and certain things lag. The bullion, at least at this point, this is not always going to be true, but the bullion is tied right now to the spot market. So that could be a leading indicator. However, it'll move up and down with the manipulated spot market because, of course, we know it takes $1.10 for central bankers and their minions to control 100 ounces of gold. So that's pretty easy to do. Whereas the collectible gold, the higher quality collectible gold, because there's certainly some semi-numismatics that would be true for as well. But the numismatic collectible gold, that is a different kind of market, and that's a more physical market that is not really influenced as much by the spot price. Psychologically, certainly, because that's the job, that's that perception management piece. If they can get you to not buy gold to begin with, that's the thing that they like the best. So the numismatic coins are definitely more stable, and there are definitely times where they always outperform over a long period of time. Short term, anything can happen. But long term, depending upon the category, and remember too, I did a webinar, gold, silver, physical or fiat. That's actually, if you go and you watch that webinar, you'll see that piece more. That's where I really address that. But the collectible coins always outperform, typically, the bullion or the spot market, and particularly over a longer period of time. Short term, anything can happen. But, you know, longer term, yes. In some cases, 2 to 1, 28 to 1 in some cases as well. So they outperform. Any other questions? Okay, then. I guess that's it for today. I hope that you found value in this, and I really, 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 really hope that you saw that the behaviors that the central bankers, all of these monetary policies, they're insane, and they're just getting crazier. They're out of ammunition. So this next big shock, what are they going to do? More of the same? Oh, and I will mention this. Kuroda, so the Japanese, so in Japan, they just announced another huge stimulus piece. How did that impact anything? So that means that what they're doing is losing steam anyway. So that's it for today. Oh, wait, another question, sorry. You're welcome, you're welcome. If there's a collapse, how will I be able to cash in my gold? Well, you're not going to convert that during the collapse. You're actually not going to want to convert your gold into cash, but that's probably pretty easy to do because during these periods of time, that's when people understand what's actually happening in the market and what happens to the value of the currency. It's one thing to lose 96% of your purchasing power over 103 years, okay? It's another thing to lose 103% of your purchasing power overnight. And so if you want to see what that looks like, then again, you know, I'll direct you to Venezuela, I'll direct you to Argentina or the Ukraine or even Greece or Portugal. This is physical, it's real money. You're not going to want to put it into dollars unless you need dollars to do something with. You're going to want to put it into the asset itself. And anybody that is actually selling an asset at that juncture will prefer to have physical gold to fiat money because everybody is aware at how quickly that's losing value then. So it's actually very liquid, very easy. 100% of the time you can convert gold into any good or service or fiat money. You cannot always convert fiat money into any good, service, or gold. Okay. I think that's it. Thank you very much for coming today. I hope you found value and you saw how close we are to the collapse. Get ready, guys. Please get ready. Until next time, see ya. You're welcome, David. See ya.